Hi everyone. Today let's deep dive into the concept of beta and alpha with respect to mutual funds and how these numbers of beta and alpha is going to help you in picking up good mutual funds. So before understanding the concept of beta and alpha, the basic or larger concept which drives these numbers comes from a model called capital asset pricing model, which is generally in financial world called CAPM model. So CAPM model, what it says is the return for any instrument or any fund is actually a function of risk-free rate and the benchmark return and a factor. So what it says is return of a mutual fund or any asset is basically comes from two parts. One is the risk-free rate and one is a factor which is multiplied by the difference between the benchmark rate and the risk-free rate. So this factor is generally called beta, and this beta is taken to the concept of mutual funds as well. So for the purpose of mutual fund analysis, this beta is nothing but the division of excess return of the fund over the risk-free rate to that of excess return of the benchmark to that of the risk-free rate. So once you take this fraction, you get beta. So what does this beta number tells you is the relative excess return of your fund to that of the excess return of the benchmark. Now let's see what will be alpha. So using the concept of beta, say we have a number x as beta, say let's assume it's 1.5, and let's actually look into a situation. So let's see there is a mutual fund. The mutual fund name is ABC Mutual Fund. This ABC Mutual Fund has a beta of 1.5. And this ABC Mutual Fund has a benchmark which is Nifty 50. And let's assume the risk-free rate in this case is a 1-year treasury bill and the rate of return is 4%. So what will happen if the benchmark gives a return of 10%? So now if we calculate the fund return, it will be nothing but the summation of your risk-free rate to that of beta multiplied by the difference of your benchmark rate and the risk-free rate. So difference of your benchmark rate and risk-free rate is 10% minus 4% is 6% multiplied by 1.5, which is a beta we assumed. We actually get 9. And when we add this 9 to 4%, which is the risk-free rate, we get 13%. So what we are essentially telling is when ABC mutual fund with respect to its benchmark, and when the benchmark gives you a return of 10%, this ABC mutual fund would essentially theoretically give you a return of 13%, which is in excess of the benchmark return, right? So as a matter of fact, if beta is higher than 1, you actually get a better return to that of your benchmark when market goes up. So now let's look into what happens when the market goes down. So let's assume market went down by 5%, and putting these numbers into the equation, the benchmark, which is the market goes down by 5%, your fund is actually going down by 9.5%. So now you understand, right? When market goes up, where if the beta is higher than 1, you actually get a return better than that of market. So when market goes down, when beta is higher, you actually get a return worse than that of the market. So beta is more like a leverage kind of stuff. So if you actually look into beta, and if you're actually going for a beta higher than 1, you can expect a volatility greater than that of the benchmark. Now let's look into alpha. So now what alpha says. So whatever the 13 percentage or minus 9.5 percentage we calculated during the market going up or market going down is the theoretical value. Now suppose the fund actually delivered when market actually going up, fund actually delivered a return of 15 percentage when compared to what we calculated as 13 percentage. This difference 2 percentage is the alpha of that fund. So this 2 percentage of alpha is attributed to the stock selection of that fund manager. So a positive alpha always shows the ability of the fund manager to pick up the stocks within the conditions given or within the market given and give you an excess return. So a positive alpha is always better. So now let's see how alpha will play when the market goes down. So when we are getting this 9.5 minus 9.5 percentage return, if we add the alpha of 2 percentage, I mean assuming the fund manager is able to sustain that alpha when market goes down also, you are getting a return of minus 7.5 percentage, which is better than that of the what CAPM model says, right? So this also gives you the ability of the manager to limit your losses when market goes down. So this is the concept of alpha and beta. Now let's look into how we can use these numbers actually to pick up good mutual funds. So when you actually go and pick up mutual funds, suppose you are looking to a risk profile of larger market and you are actually going for funds which are tracking Nifty 100, but you are a person, you actually don't want your fund to have all the risks of that Nifty 100. You actually don't want your return to be as move as with that of Nifty 100 index. In that case, you can actually go for a beta of less than 1. Basically, you pick up mutual funds with beta less than 1 and you tend to get a return better than that of the Nifty 100 when market goes down, and you tends to get a return not as good as that of Nifty 100 when market goes up. Also, one thing you need to consider while selecting beta is the average beta of the category of the mutual fund. Suppose you are going to a mutual fund category, say large cap equity fund. So if the category average of such a mutual fund is say 0.95 beta, and you are actually seeing a fund at a 0.85 beta. So compared to the average of the all the available funds, you are restricting your risk. You are not taking too much leverage and you are restricting the risk relative to the benchmark. And alpha is always a positive figure, in the sense if you have a good alpha, that's always a positive thing from historical point of view, and which actually tells you that the fund actually performed better than that of the beta predictions, the theoretical predictions, because of the stock picking ability of the fund manager. So now you guys should be very comfortable in using alpha and beta to pick up mutual funds and actually to understand this concept from the first principles. Thank you.